Are you sitting on a gold mine in your brokerage account, but you're terrified to touch it because you're afraid the IRS is going to swoop in and take a massive cut? Listen to me, because this is your hard-earned money we are talking about. You have spent decades, saving, sacrificing, and doing the right thing. You've watched the markets go up and down, you've stayed the course, and now you're at the finish line. But here is the problem: most of you are so afraid of the taxman that you're either paralyzed, keeping your money in accounts that aren't working for you, or worse, you're going to go out and sell your winners all at once and hand over a fortune in capital gains tax that you didn't have to pay. You have to understand how this works. Capital gains tax is not like ordinary income tax. When you sell an investment that you've held for more than a year, like a stock, a bond, or a mutual fund, that profit is a long-term capital gain. And in retirement, the way those gains are taxed can be your greatest friend or your absolute worst enemy. The fear I hear from so many of you is that if you sell your stocks to fund your retirement lifestyle, you're going to be bumped into a 20% or 30% tax bracket. But here is the reality: for many of you, if you play your cards right, your capital gains tax rate could be 0. Yes, 0. In 2026, the tax brackets are very specific. If you are married filing jointly and your total taxable income stays below a certain threshold, you pay 0% on those long-term capital gains. But the second you go $1 over that limit, you start paying 15% and eventually 20%. The danger here is tax bracket creep. If you don't have a plan for which account you're pulling from first, your 401k, your Roth, or your taxable brokerage account, you are essentially guessing with your future. And we do not guess with our money. So, what do you do? How do you minimize what you owe? First, you must look at tax loss harvesting. If you have some dogs in your portfolio, investments that have lost value, you sell them to offset the gains from your winners. You can use those losses to wipe out your tax bill on the gains, and if you have more losses than gains, you can even use up to $3,000 to offset your ordinary income. Second, you have to be smart about the bracket bump. If you know you're going to be in a low-income year, maybe you've retired but haven't started taking Social Security or your required minimum distributions yet, that is your window of opportunity. That is when you sell those highly appreciated stocks and lock in that 0% or 15% rate. It is called tax gain harvesting. You sell the asset, pay little to no tax, and then you can buy it right back if you want, but now you've raised your basis, which means less tax to pay in the future. Third, please, if you are charitably inclined, do not give cash. If you have a stock that has gone from $10 to $100, do not sell it, pay the tax, and give the cash to your church or charity. No! You give the stock directly to the charity. They get the full $100, and you never pay a penny in capital gains tax. You have to be a warrior for your own wealth. You cannot be afraid of the IRS, but you must be prepared for them. Every dollar you save in taxes is another dollar that stays in your pocket to pay for your health care, your home, and your peace of mind. You have worked too hard for this money to let it leak away because you didn't take the time to understand the rules of the game. Get honest with yourself about what you owe, get brave enough to make these moves, and stay disciplined. With that said, thanks for watching, and until next time.